This is an Uncovered Japan Company Research Report on CEC Corporation, ticker 9692. CEC is an independent Japanese system integrator working across legacy migration, public sector infrastructure, connected vehicles, and cybersecurity. The investment story pairs solid operating economics and net cash with an important question: how much of recent growth is durable, higher quality profit? The snapshot is straightforward. CEC traded at about 11.8 times forward earnings, with a 3.9% dividend yield and roughly 24.8 billion yen of net cash. Return on equity was about 12.5%. Those numbers are attractive, but the right question is whether the earnings quality and growth drivers can support them. CEC is not a consumer software company. It sits in the plumbing of customers' operations. It helps migrate aging systems, builds and runs public sector infrastructure, supports connected car and manufacturing workloads, and sells cybersecurity and proprietary software. Its defining feature is vendor neutrality. Unlike a maker-affiliated integrator, CEC can recommend a stack based on the client's needs rather than a parent company's hardware. The segment mix explains both the strengths and the work left to do. Integration is 65% of sales and earns a 20.5% segment margin. Solution, which includes cybersecurity and proprietary products, posted 30.6% order growth. Connected also earns a strong margin, but its orders fell 1.2%. Re-accelerating that segment is a concrete test of the strategy. Revenue rose from 45.2 billion yen in fiscal 2022 to 65.9 billion in fiscal 2026, a 5-year compound growth rate of 9.9%. Operating profit also rose, but fiscal 2026 operating margin settled at 11.1%. That distinction matters because public sector hardware sales boosted revenue while carrying lower margins than pure engineering work. CEC's balance sheet is a central part of the thesis. Its equity ratio was 68.4%, and the company held about 24.8 billion yen of net cash. That financial flexibility supports dividends, buybacks, and targeted investment in higher value services. It also gives CEC a buffer that many smaller project-based IT companies do not have. CEC does not depend on one spectacular monopoly. Its defensibility is a bundle of practical advantages: vendor-neutral architecture, domain knowledge in regulated and failure-intolerant systems, and the cost and risk for a customer of replacing an embedded provider. The opportunity is to add more recurring cloud revenue and proprietary products on top of that installed base. Management's long-term ambition is to become what it calls an essential company with 100 billion yen of revenue. The nearer checkpoint is a fiscal 2028 revenue target of 72 billion yen, and management also aims to lift cloud revenue mix to 35%. The plan focuses on cybersecurity, data utilization, and legacy migration, where demand tailwinds are tangible. On the report's peer comparison, CEC screens as the cheapest of the selected Japanese integrators on earnings. At roughly 13 times trailing earnings and 1.6 times book value, it trades below the larger peer group. Some of that discount reflects real differences in scale, visibility, and liquidity. So the valuation is a starting point for analysis, not a conclusion on its own. The report's 3-year scenario work shows how sensitive the outcome is to execution. The author's estimates frame roughly 23% downside in a bear case versus 41% in the base case, and 127% in a bull case by fiscal 2029. These are scenarios, not price targets or recommendations, and they hinge on margin recovery, order momentum, and the pace of growth in CEC's focus businesses. The risks are specific. Low-margin hardware can make revenue growth look better than profit growth. Connected orders need to recover. A cost base with substantial subcontracted labor remains exposed to wage inflation. And thin trading liquidity, together with crowded margin buying, can limit near-term share price momentum, even when fundamentals are sound. The balanced conclusion is that CEC is a financially strong, vendor-neutral Japanese integrator with real demand tailwinds in migration, government digitalization, and security. The valuation and dividend are appealing, but the thesis depends on better quality growth and on the supply-demand overhang easing. Track the order book, margin mix, and connected segment before drawing your own conclusion. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.